Hey, what's up, guys? John here. We are witnessing a massive bloodbath in the stock market. To me, it looks like this could just be the beginning for a couple reasons. One is we're seeing that euphoria leave the market. We're seeing a lot of people looking at the downside. They're really cautious about where they invest money because everything is getting so damn expensive. And the free-flowing cash register that they turned on is just turning off. And people are looking at gas prices, looking at the cost of living, saying, you know what? I can't afford to risk it. They're starting to pull money out. And what I think is going to happen next, I think interest rates are likely going to continue rising. And as they do, it's going to be harder for these non-profitable companies, these companies that produce very little value. Look at companies like Revlon. Look at Peloton. Look at a lot of these tech companies as well that were doing well a year ago, 2 years ago, 3 years ago. They were doing well, but now they're bleeding out. They're doing mass layoffs. Even Carvana, Netflix, Twitter, a lot of these companies are doing big layoffs and their stocks are pummeling. But what I think is going to be interesting here is as interest rates rise, investors are going to say, you know what? It costs a lot more to borrow money. And because of that, there's going to be more opportunity. So if I have $1 million, I can go out there and invest in multifamily property. I can go invest in, there's a variety of different asset classes in which they can invest their money in. They'll have a little bit more security. That will have a little bit more certainty and more stability in these uncertain times, right? And so as that begins to happen, what's going to happen? These companies are going to lose access to cheap liquidity, which is then going to put them in a position where they're going to have to do more hiring freezes. They're going to have to reduce their footprint. They are going to either close down entirely or completely restructure their organizations. A lot is going to change in these uncertain times. Seen this very interesting article here. Stock prices rise and fall on two things. Essentially, how much cash a company produces, which lately, last couple of years, has been very little for many companies, and how much an investor is willing to pay for that. So investors are going to be paying less for uncertainty. The Fed moves on interest rates heavily influence that second part. Since early in the pandemic, record low interest rates engineered by the Fed and other central banks helped keep investment prices high. Now easy mode for investors is abruptly and forcefully getting switched off. Not only that, two aggressive rate hikes by the Fed could ultimately force the economy into a recession. Higher interest rates make borrowing more expensive, which drags on spending and investments by household and companies. One of the fears among investors is that food and fuel costs may keep surging regardless of how aggressive the Fed moves. Well, that's obvious because we're transitioning. So there's going to be less fuel available. More people are going to be desperate for it, right? And so what's going to happen? Prices are just going to continue going up. The fact is, and that's all going to get pushed back to us through everything that we buy in stores. Everything gets shipped and sent to us in trucks. The fact is that the Fed has very little ability to control food prices. This is BlackRock's Chief Investment Officer of Global Fixed Income said in a statement. He pointed, and I've been saying this for a while too, he pointed instead of mismatches in supplies and demand, higher costs for energy and wages, and the crisis in Ukraine, which is a major breadbasket for the world, that raises a threat that central banks will overly tighten the brakes on the economy as they have pushed against a string and essentially fall into a damaging policy mistake. The economy has already shown some mixed signals, and a report on Friday indicated consumer sentiment is worsening more than the economists expected. Much of the sourcing in the University of Michigan's preliminary reading was due to higher gas prices. That adds to several recent profit warnings from retailers indicating U.S. shoppers are slowing or at least changing their spending because of inflation. Such spending is the heart of the U.S. economy. The 2-year Treasury yield zoomed to 3.05% following the inflation report from 2.83%. Late Thursday, a big move for the bond market. During the day, it touched the highest level since George W. Bush's presidency, according to data from TradeWeb. The 10-year yield was also up, but not quite as dramatically as a 2-year, which is more influenced by expectations for Fed movements. The 10-year yield climbed to 3.15% from 3.04% and touched the highest level since 2018. We look at all of these stories that are breaking out. Tesla stock dives. This is what I think is going to happen. I think that we're going to let this see them get very aggressive with rate hikes. And why do I think that? They said that the main priority is going to be combating inflation, right? Combating inflation. Well, we missed the inflation target just last week. So what are they going to do? They're going to try to make up for that. Are they going to go 50 basis points? They're going to go to 75 basis points? We don't know. But what I do know for sure is that when you look at household debt, household incomes, the household incomes are not meeting inflation. People are going to be pushed into desperate positions. We're going to start to see people sell off crypto, sell off stocks. A lot of people would say, hey, John, Bitcoin is the new gold. But if we look at stocks, we look at Bitcoin right now, Bitcoin and cryptocurrencies are following the stock market, right? They're both going down. At least, gold in many respects is holding value. It's not being as impacted by this, this transition, right, in this economy. Now, what I think is very likely to happen here is I think we're going to start to see an erosion of this comfortable lifestyle that Americans have been used to over the, many years. I think this is going to change. I think we're going to see a lot of money come out of stocks if the Fed continues to increase interest rates. And if that does happen, where's the money going to go? It's a big question. Where are they going to invest the money? I think a lot of people are going to be investing in real estate as interest rates continue to rise. And why would they invest in real estate if interest rates are going to rise? Well, they would invest in real estate simply because they would be able to take advantage of lower prices. They'd be able to take advantage of lower prices because generally when interest rates rise, what happens? It costs more to borrow money. And so home sellers generally bring their prices down. But there's going to be a lot of money on the sidelines right now waiting for those great deals, whether it be private equity funds, insurance companies, pension funds, large corporations. They're sitting on so much capital. They've made so much money over the past couple of years. What are they going to do? They're going to buy entry-level housing. That's what I believe. So I think that the stock market could crash, continue to crash. We've seen nothing yet. If we look at what the stock market was doing, let's just say a year ago, and then 5 years ago, I mean, we really haven't seen that big pullback yet. We are starting to see it. We're hearing predictions, 25, 30% down from where we are now, in addition to where we are now. Now, I believe that is all in the scope of possibility. I think what happens, though, during downturns is great fortunes are made. They're made in such great scale. A lot of people that have gotten extremely rich, they don't get rich in the big bull run. Sure, some of them do. Most of them get rich by putting a big bet, and placing that big bet when everyone else is afraid, when they don't want to touch that investment. This is the moment where you're studying, you're coming up with a game plan, you are reducing your liabilities and bringing yourself to a position of strength, getting a really strong foundation, really studying, getting great credit, and putting yourself in that position. Because if a great opportunity comes and you want to go ahead and buy it, but you don't have the wherewithal to do so, there's going to be 100 other investors that are going to dive into that position. Because we are in the greatest wealth transfer. We're in the greatest wealth transfer in American history. It's happening before our eyes. And there's been so many people. I've been mentioning this for a while. Q3, Q4 of 2021. I said the smartest people in the world right now are selling. Smartest people, the billionaires, they're all selling now. Everyone else is buying. I believe it's for a reason. And now what's going to happen is when this rug pull happens, what are these smart people going to do? Well, they're sitting on so much money from liquidating their stocks. They're going to run out there and start buying. Even like Bill Gates right now, he's in China building out a whole team based around rental housing, right? You have Bill Gates doing this. You have all these large corporations that are doing it, buying up housing. When things really start to hit the fan, people's retirement plans, their 401ks are falling with this, and people are simply, they're on fixed income, and they're based on, they were living their lives based on the reality of a 2 or 3% inflation, and now they're getting hit with a 15 or 20 or 25% inflation. People are going to be forced to sell, and who are they going to sell to? That's the big question. What do you think about this entire situation? Do you think we're stepping into a situation where stocks are going to continue to come down, and the net response of that is that investors with a lot of capital and cash are going to get a little bit more defensive, chase bigger yields in which they can control the net outcome and performance of that asset, such as real estate? Or do you think that they're just going to continue buying stocks? Drop your comment below, hit the like button, subscribe. You'll subscribe on my second YouTube channel. It's going to be an interactive show and a podcast starting this upcoming week. And if you need help with your credit, I have an amazing team that specializes in credit repair. You want to get started on YouTube, get on the YouTube grind with me. Cashnow.video. You want to invest in real estate when things hit the fan? Cashnow.video. And LinkedIn, Twitter, Instagram, TikTok. Follow me over there, and I'll catch you guys in the next one.